These are some of the terms and definitions: variance and covariance, correlation, and R2. We have seen how to calculate the SHOP. Now, going back to the slide or any other slide. One is better than two. Right, so obviously we'll pick up two. The two could be, in this case, mid cap and something else, the top two. Mid cap and I think next 50. And then if you were to pick up two out of these, you will obviously pick up FMCG and IT. And if you have to pick up two from this, based on this data, you will pick up alpha low-vol and Momo. Right? Now what we'll do is, let's do two and allocate our money, right? What is the allocation method that you can think of?
Equal weightage.
Equal weightage. Now, because we have a lot of this math, we can do a different approach, right? This particular approach is called mean variance, or basically the Sharpe ratio based. Like if you mix in a ratio where my Sharpe ratio is highest, because Sharpe ratio is the single most important metric when you compare multiple assets, whether you agree or not. That's the most prominent measure, and that's the most quoted measure, right? Fund managers quote, this is my Sharpe ratio, like your army officers put their badges on their shirt, right? So fund manager puts his Sharpe ratio on his as a badge, nothing else. I mean, you can argue comma ratio, information ratio, SOT, there are so many ratios like that. But Sharpe is the most widely used, acknowledged measurement. So our concept is mix any of these two assets where I get high Sharpe ratio. So for that, this is my template, right? I'll put everything in the same sheet. What's happening? This is two assets. What are the two assets that you would like to select? Anything. We have that gold, I'll let somebody else do. In this case, because we have these two, I will do this, right? Because I already have a ready-made data, FMCG and Nifty combination, right? Now the question of look back period. I can dig all the data and get for 100 years if possible, or I can set some reference as a way that I follow. The reference that I follow is do at least for last 10 years. The reason is last 10 years is the most recent behavior, and I don't care how various asset classes performed 40 years ago. The reason being there is I don't live more than 40 years in my investment career, right? Because I start at 25 and I will probably retire or have no energy to continue the game after 55. So that means I have only 30 years of self-worth. So it doesn't matter how 40 years ago, which index performed, how and all this stuff. So I want to see the recent performance and decide accordingly. So that recent performance is probably 10 years. 10 years being a couple of bad years, couple of good years, 5 normal average years. So with that, I would delete all the data prior to April 12. Or I will just put an end to it. I'm not looking beyond this, right? So the first step is your returns. Your returns are this into 100 by this one. Same thing. Just make it 2 digits. And continue across the board. And the first step is average returns for each. So this is average. And the same thing for Nifty 50. No, somehow they're the same. There's a little bit difference, 131.8 and 131.9. And standard deviation of these returns. So your FMCG and Nifty returns are the same, 1.09%. Standard deviation of FMCG is lower and Nifty is higher at 4.75. Now my asset class mix could be this and this. So if I put 0% here, I'll get 100% here. If I put in steps of 5%, then I will get 95% here. So I will drag it. My returns in this mix would be what? This into this one. I have to log that, plus this into this one. Because I'm putting everything into Nifty, I will get Nifty kind of returns. If I put 50-50, I'll get average of them. So this is my returns. You are not seeing the difference because the numbers are like that. Now you will see slight change. Now calculating the standard deviation of portfolio. How will you do it? How will you do it?
Do you need to take into account the covariance or something like this?
Yes. So just search standard deviation of two asset portfolio. This is variance covariance method, right? So portfolio standard deviation is the final formula. Portfolio variance is this one. Variance is basically weight and sigma of 1, weight and sigma of 2, and covariance of 1 and 2. Covariance is nothing but P is nothing but correlation, and sigma 1 and sigma 2. Now, let's get this equation here. Now, this equation is gone, is nothing but correlation, that is P12 or correlation 1 and 2, and sigma 1 and sigma 2. Sigma 1 and sigma 2 multiplication. And standard deviation is nothing but square root of variance. In MSc Quant Finance or any of the quant master's degrees, you will actually get a step-by-step explanation of this, how this equation is arrived at. Yeah, but I'm not teaching you to be MS Quant, so accept as it is the formula, because we copied from a reputable website. So now what we require is we have sigma and weight and returns. Okay, there's no weight. Sorry, there's no returns, only the variance, the weights. Right. So now we need to calculate the second part of this equation, which is nothing but correlation. This is of this and this. Now variance is, you have to clearly observe. If I do any mistake, you have to correct me. So weight 1 power 2, weight 1 power 2 into sigma 1 power 2. And now this I need to log it, plus same thing, weight 2 weight 2 into sigma. Lock it and power 2 plus 2 into weight 1 into weight 2 into correlation, lock it, into sigma 1, lock it, into sigma 2, lock it. Now standard deviation is square root of this. You will get to know whether your formula is correct or not by cross verifying this and this, because this is 100%. So it should match with Nifty 50 figure. If they match to 3 or 4 digits precision, then your formula is correct. Similarly, cross verify here. This should be nothing but FMCG variance 4.21. 4.211. So 4.211. Right? So your formula is correct. Now your Sharpe ratio, you can simplify it by setting risk-free rate to 0. Like if you go back to this equation, the excess portfolio returns, I don't need to calculate because I'm setting risk-free rate as 0. Then my excess returns are nothing but my returns minus 0, which is my returns only. And calculating standard deviation, yes, calculate on my returns because you are setting risk-free rate as 0. Now the simple equation now becomes just the portfolio returns minus 0 divided by standard deviation of my returns. No excess returns because excess returns are not there. Risk-free rate is 0. These are your returns and this is your standard deviation. Now, if you have a difficulty of reading this number, just multiply it by 100. I mean, they all look same. Maybe multiply it by 1000 and write 100 times Sharpe. Now you have the entire table of various ratio allocation. What is the best ratio? What is the best ratio?
65-35. Sorry, 65-35.
Wherever is the highest Sharpe ratio, right? So where is the highest Sharpe ratio? Either you can strain your eyes or you can do this. The highest, the thicker the green, that's where. Probably this one. 65-35. You also can take, this is, I don't know how to magnify that number because it's the same number across the board. There's slight variation we can't observe. So if I magnify that by, let's say 1000 times of returns, or maybe 100 times because we did 100 of that. And this is your returns, and your standard deviation is this. And if you draw a graph, this is what people call as efficient frontier. What it means is, as you go up, your returns are increasing, right? Your returns here are 108. Here they became 110. Of course, we multiplied by 100. And as you go on x-axis, from left to right, what happens? From left to right, what happens?
The standard
Standard
deviation.
deviation, increase in
What's that?
standard deviation.
Standard deviation is nothing but risk.
Risk, yeah.
So your risk is increasing as you go right. Right?
Yeah.
Now you want risk and return to be optimized. That point is, if you draw a line, it will meet somewhere here. So something like this, right? So this is where the point that is called your efficient frontier or mean variance optimization or whatever the word you call it as. I will leave this graph. Let's see what happens. And I will unhide.
No, doesn't take it.
So you have to redraw.
Yeah.
Right. So now my thing is, I don't have patience to do this each step because I've done it in 5% steps, right? I can increase the granularity to 1% and make it as 1% or 99% instead of 5% or 95%. And I can do 100 points like that and get a better Sharpe ratio rather than just telling me this number 65 and 35. It could be something else. It is 66 or 64. We don't know. So what we'll do is we will find a generic equation. All right. So this is what, and this is what it is. Now I want to change this. So automatically everything changes. And I want to maximize my Sharpe. How do I maximize by Sharpe? By fiddling here from anywhere between 0 to 100. Now to do this, you have an Excel beautiful facility called Solver, Excel Solver. To install that, if you haven't used so far, it will appear like Solver. That is if you had installed. If you haven't installed, go here, File, More, Options, and add-ins. So you will get Excel add-ins and go. This one, Solver add-in. If you click that, okay, it will install here on the Solver stuff. Now, if you had installed a Solver, you need to set up that Solver function. What is the Solver function I'm doing? Maximize this by changing this. Solver set objective is this one. What is my objective? I want to maximize it. How do I do that? I want to change this. And I can set some of these options like don't waste more than 30 seconds. Sometimes your Excel is slow, it will be calculating for more than 2 minutes or maybe 60 seconds, whatever it is. And then I also can set my conditions saying that I don't want to go more than 1% or 100%, right? So I can put that condition here. Sum of both should not be more than 100. How do I do that? Something like this is, oh, I'll close this and I'll come back. Something like this, right? This plus this. That shouldn't be this add a constraint, which is nothing but this is equals to 1. That means I'm only using 100% of my capital. I also can set it to 200%. That means 100% I'll borrow. And let me see that equation kind of stuff, right? You can do whatever you want. Now solve it. Maybe.
I optimized for G2 on the top. On the objective, using G2.
Okay, first I have to delete this. This is G
M.
And this is H. So it's solved from 50, which we started with, ended up at 66 and 33. So this is your highest Sharpe ratio. 66% of FMCG and 33% of Nifty is what I would go with if I want to achieve my highest Sharpe ratio. Now what I can do is this particular combination, I can do a graph, something like this, right? I actually want to calculate monthly returns. Monthly returns of this portfolio is nothing but, let me get that ratio here, the optimized ratio, this, and the next one is that. This is your allocation. Now your monthly returns of this is into this, lock it, plus this into lock it. So this is what your returns are. Now what the equity profile and everything for this is, just make a copy. Two assets. Actually not this. I will make this as a copy. This I would call as two assets. Two assets, alpha, beta, all that. What is that I need to feed? My benchmark is already here. Instead of FMCG, I'll put two assets. And this returns, I will delete. I will get this returns into the other sheet. And because I have 10 years of data, I would delete the benchmark stuff. So I shouldn't be having all this. I'll put 100 as my starting equity. This is what it is. Nifty has become 153. Actually, you have to calculate only for 10 years. This one, right? So how to do that? Only for 10 years. Go to this place and delete everything. This is where you need to do 100. So you got this data. And redo, I mean, like, you know, I mean, just go back and fiddle with the sheet. All that you need to do is drag all the formulas here. So this is my two assets combo. What did I achieve in this whole asset allocation game? What did I achieve?
Higher sharp ratio.
Also, I reduced my max.
MDD is lesser, sharp ratio is better.
Yeah.
Yeah.
So this approach has at least given me something better than the Nifty 50, right?
Yeah.
And in fact, the returns are also a little higher, 337 versus 333, 322. CAGR is 0.5% higher. You know what is 0.5% high CAGR means, right?
Yeah.
Over a 20 years period, you will get another 100.
1x of it, yeah.
And my beta is less now. I'm not much bothered. Because if index loses 10% this month, I only lose
Around 7%.
around 7%. The bad side of it is if index rallies 20% in the next,
Exactly. Yeah.
I only make 14%, which is fine.
Yeah. That's the R square. No?
You cannot tell me 30% of the times I'm doing something different than Nifty 50.
Yeah.
Only performing similar 70% of the times to
yeah.
I'm doing 30 something different in those 30% of the times. My free returns, even though my returns look same, right? Or same, but my alpha is high.
Yeah.
That is because my beta is low. Alpha is nothing but risk adjusted returns. That's how you can call them. So my risk adjusted returns, excessive returns are 0.17% per month. So in a year, I make into 12. I think about 2%, right?
Yeah, correct.
That number. So I make 2% excess returns, risk free. If you don't have alpha, do not venture. That's the whole lesson. At least in your Excel sheet, which is what you are doing, you should have at least generate alpha in Excel. Forget about the real world. At least this is in your control. So you fiddle and try to generate alpha at least on Excel sheet. That should be right. Now, if any of you want to do, let me know your email ID. I will ask you to do this for something else. Who is going to share and do it? Tell me, who has a computer? Yeah, I mean, like any of you. I don't want to choose randomly. I want you to come up, or I can put any name, so it will come to you. Umesh or David?
Sure, correct. I can put. You can send to me.
I think I need to close this. Okay, you got the template. You share your screen.
Sure. Just downloading it now. Yeah, I'm sharing my screen.
What I can do is make a copy of two assets. No, the third sheet.
Oh, third sheet. Okay.
And drag it at the end.
Yeah.
Drag it at the end. New copy of yours. Make it.
Yeah. Yeah. Sure.
And change the name to FMCG and gold. And change my two assets to FMCG and Nifty 50.
Okay.
So yours would be FMCG and gold. Mine is Nifty 50 and instead of two assets, make Nifty and FMCG.
Yeah.
Rename.
Just give it. Yeah. Nifty FMCG. Mine is FMCG and gold, is it?
Yeah, I mean, I'm just let's try with FMCG and gold. What happens? Mine would be Nifty and FMCG. And two assets alpha is Nifty and FMCG alpha. Push that sheet ahead.
Okay. Yeah.
Now you need to get gold monthly returns, right?
Yes.
Go to BSE website. Because I found this very useful in the way they went the data. So go to market data. Come down.
Historical data.
Historical data. Oh no, I think again you have to select market data. Go on top.
Oh, okay. Yeah, right.
Yeah. Select historical stock prices. Instead of equity, change it to mutual fund. And that would be gold bees. Yeah, Nippon, that one. And select monthly from 2012, right? Jan 2012.
March, I think, right?
Yeah, but select from Jan, we'll
Oh.
delete it.
Oh, okay, okay. Jan 2012. There is 2.
I think that's it. You just need
Oh, okay.
download. Just only the close price, reverse sort.
Okay, yeah. Should I remove this? Correct?
Yeah, delete.
Yeah. So this is also not. Okay.
Reverse sort. Did you do it?
Yeah, yeah.
You
So
don't need percentages. We'll calculate this. But if you go down,
okay.
keep going down. See, the gold was at 2706. It was split by a factor of 100 or 10 somewhere. So you have to adjust the price.
Okay. Oh yeah, here.
Yeah, there. So from November 19th, you should divide it by 10.
So should I create one more column with that?
Yeah. So that's equals to that by
100.
100.
Yeah. Yeah.
And the other one will be equal.
Okay.
Now this would be actually a gold price. Now, because there's a formula, right? Copy it via notepad into the original sheet. The FCG, you just replace this as gold. Sorry, Nifty as gold.
Okay. Yeah, right. Yeah.
Change the heading to make it 2 digits. And change the heading to gold. A good sheet would actually point to equals, so you don't change all the places.
Yeah.
Now, tell me the ratio.
Sorry. So,
you just need to reset it to 0.5. The final LO.
oh yeah, here, right?
Make it 0.5.
Yeah.
And use your solver.
Can't run macro server.
I think some privacy settings somewhere.
The recommended in this book or macros may be disabled. Okay.
Maybe trust center. I don't know where. I never trust everything.
Contents. Macro settings. Yeah. Enable all macros. Okay. Okay, it's not.
Umesh, you just added in the plugin, right, for solver. So I think if we, it might need a close down of Excel and opening that again might solve this.
Okay, let me save that.
Save the, probably you can save this and close it and open it again. It should work.
This workbook.
Okay, you send it to me because you figure out.
Yeah.
To do 4 assets also.
Okay. Sure.
I don't want to. I mean, I can extend, but I want to.
Yeah.
At least be in line with the lunchtime. So you send me that sheet.
Yeah. Sending it. Let's see. Yeah. Encore.
Solve M32 by changing the H32 solve. It looks the same ratio, even for FMCG and gold. The good thing about FMCG and gold combination is this one. Your correlation is negative now, not exactly negative, but somewhat negative. And you get at 66%, right? This would be your average returns. Your returns have reduced from 1.1 of Nifty to 0.88. And if you get this one here. This is FMCG and gold. Is there an alpha in this? What should I do? This becomes FMCG and gold. Whereas here, this is FMCG and Nifty, right?
Yeah.
FMCG and so here, these values I don't have, only the change I have, right? Delete all of it and get this one. And paste it here. What did I achieve? What did I achieve by this combination? Returns have reduced, but the is eliminated now. I mean, or reduced a lot. You can see in the standard deviation, Nifty standard deviation. Right now, the standard deviation of this portfolio is only 3%. The other Nifty alone combination would be this one. Nifty alone combination standard deviation is
4.75. Yeah.
So we reduced almost by 60% from 5 to 3. Right?
Yeah.
And okay, I don't. What are the Nifty returns?
Around 11, around less than, slightly less than, yeah.
Okay, it's the same 10.08. And this one. Yeah, so Nifty is about 12.5, 12.3.
12.5, yeah. This is 10.
Mine is 10.5.
Slight.
But now I'm not at all bothered about drawdown. It's just 10% drawdown, right? Versus 30% drawdown for Nifty. So I achieved something. Even though my returns are less because my beta is considerably low now. So I still generate alpha. And the beauty of R2 is you really don't know what I'm doing at all.
Yeah.
Right. So only 25% of the times you know, okay, he has some Nifty 50 investment. But rest of the 75 times you can't even guess what I'm doing. I'm doing something completely different.
Yeah.
So yeah, I'm foregoing returns in terms of lower volatility and lower.
Yeah.
And Sharpe ratio hasn't increased considerably, but that's fine because I'm seeing benefits elsewhere, like in maximum drawdown and. Now you can extend this to 4 portfolios. I will give you a link where it is thoroughly explained. Right now, just accept this template. Where is the template?
Asset allocation.
This is a material where you can get it. I will forward that to you. Link after the. This has various copies. This is what it is. All right. So let's get for our 4 instruments that we have, right? I'll delete everything. So I will optimize construct for 4. What is this? This is nifty. And I have my FMCG. This one. And I have my IT somewhere here. Actually, I deleted, right? IT. Yeah, this one, IT. I can put any index. I'm just putting what is available in front of me. You can change this to this is my IT. And then my gold. Where is my gold? This one. Actually, your values are not correct, but that's fine. Your values are not correct after this one. And anyway, I'm not bothered about all this. So this is nifty. All right. We are just doing it for these 4. That doesn't mean that I'm using only these 4 indices to invest. You can go back to this and choose whatever is suitable for you or whatever is you want to explore. Mix and match from various buckets. One thing while mixing and matching is don't select which are similar. What I mean by similar is you want diversification, right? So now if you select any of these two, you are also selecting a little bit of this, because in your momentum, obviously it has a various sectors. The sector composition being is this the one? I don't know what this is. Momentum, right? This is
momentum. I think.
Momentum. I think I closed it.
Oh.
But anyway, so just a minute time. Strategy. Momentum. Fact sheet. So if I'm investing in momentum, it's as good as I'm investing in 25% in IT. So there's no point putting IT and momentum, because you already have 25% of IT in momentum, right? So see that you get a real diversification. So you can avoid IT now, right? If you choose this, you can avoid IT.
Yes.
So now, like that, you arrive at what are the four diversified. So my thing would be gold, because gold is there's nothing in any of those strategy indices. Maybe momentum, maybe low wall, maybe gold, and then I want to go for international diversification. So I will go for NASDAQ ETF. That's a complete four different set, right? You're getting the point, right?
Yes, yes, we are.
Now the first step is it is simply the returns in this one. Returns normalized to 100. Sorry, instead of 100, it's just 1 or so this is 2% down. This is 5% up. This is 13% down. So IT got cratered last month.
Yeah. Yes, Wipro.
I'm happily holding my Infosys. So.
Yeah, I'm holding Wipro.
And what you do here is D mean. This is the normal mean, and this is mean minus overall average. So excess returns or D mean or whatever you can call. That's your first step. Second step, D meaning. And this is, I cannot explain because I'm not a quant, I'm not a MSc quant guy, but I just know the steps. I've done 100% accurate. And I'll point you to some of the lectures where they explain it much better than me. Because I cannot explain, I'm just copying the formulas. So when you are copying this particular formula, right, what you need to do is do this and go into a notepad and delete. Now come here, and if you have data of more than 122, that is more than 10 years. Suppose you want to do this mean variance optimization for 240 months. So you have to change 242 or 243. And you also select the entire bucket and go here, paste it, and do a Control-Shift-Enter. After changing these values, if it is for 240, 242, Control-Shift-Enter. the ML transpose or whatever. Then this is the sample size, which is 121 months or 120 months. And this is var covar, and this is your standard deviations. And then product of ST, that's the fourth or fifth step. And you get a correlation matrix. Nifty with Nifty being 1, and Nifty with IT is 44. Nifty with gold is negative correlation of 17. Things like that. FMCG with FMCG is 1, IT with IT is 1. So if you have done correctly, you will get 1 like this. If you haven't done correctly, then you have to go and revisit the steps. And then these are my weights. Let me set it equal weight first, 1/4. So my total investment is 1 rupee or 100 rupees. And my returns are 0.25 into the average of each. So annual returns would be 12 times of this. Now, because I'm doing equal weight, so I will get this much returns. What is that number?
0.498.
Yeah, so I got 5% returns.
5%, yeah.
If I go in that combination, and my variance is this one. Actually, it's not variance. Oh yeah, this is variance, and this is my standard deviation. And my portfolio returns are this weight into each of this translates to 4.5% with ratio of.
Just go to portfolio returns, please.
Yeah, this one.
Okay. Okay. So just weights into the returns.
Yeah, weights into the returns.
Okay.
And this is my Sharpe ratio. If 25% weightage, right?
Right.
Now I want to change the weights so that can you give me a better Sharpe ratio? Delete each of them. It's a painful stuff. One by one, you have to delete. Solve what? Sharpe ratio. That is this one. By changing what? These variables from Q42 to Q45. Do a blind solve first. It has gone bonkers, right?
Yeah.
So I have to limit this to, that's the minimum I should be setting, right? So add a constraint where my total is 1.
Add.
Now solve it. Maybe I have to start the seeding again. Now please solve. So it has done something. What it said is go, actually your Sharpe ratio was 38 earlier, now it has become 41. And your returns earlier were like 12 or something like that, right? So now they have become better at 15.5. But the problem here is, what is it telling?
It is knocked off Nifty and gold.
Don't put anything in gold or Nifty, just go with 50 and 50 each in FMCG and IT. I don't like this because I choose those four. So my constraint now is at least put something in Nifty and other thing as well. So my constraint now would be this has to be greater than or equal to some number. Maybe 10% is meaningful, right?
Okay.
But why do we want to put it maybe 10 or something? Because the equation is optimizing a result to the best.
It's optimizing because it doesn't know your investment criteria. Because my investment criteria is I have selected these four, I have to put something at least.
But why would we put in gold or Nifty? If the
I
equation
want diversification.
Okay.
I mean, you can answer as the way you want, but yeah, my condition is I want at least a little diversification.
Okay.
I know that FMCG and IT got corrected now, right? 15% down for this month. And I don't know if FMCG is flat, I'm as good as down by 7%. So it is a high risk. So if I had put on gold, I wouldn't have lost much. That way, that constraint is necessary. If you ignore, then it's as good as choosing two. This one is greater than or equal to 0.1.
So it means with the new constraint, Sharpie ratio should go up.
We don't know. We'll just check. So everything is greater than or equal to 0.1, right?
Yeah.
Now what I have to do is let me reset it back to 1/4 each. And solve it now. Now the equation has become worse. In the sense, Sharpie is reduced 35 and returns also reduced. That is because the equation thought put everything into 70. Because you put another condition like 0.1 each. Now again, this is too much. Again, put another condition saying that I don't want this to be a maximum bound, whatever that number is. So this should be less than what?
35.
Maybe 0.4. Any number you can put. I'm not saying you only put 0.4. You can put whatever is your preference. So my constraint now is at least I should put 10%, but I don't want to put more than 40%. Now solve it. This is a little better. I mean, not a little better, at least something okay. Like put 40% in Nifty, 20 each in everything. Your Sharpe ratio is 0.38 and returns are the same. Ideal, if you are targeting only the best returns, then go for FMCG and IT. But that's not a good thing because your standard deviation would have been much higher than this 0.33, right?
Mhm.
Now you have um, this weightage. Where is that weightage?
Down.
Q42. This must be Q43. This is Q44 and Q45. And my port returns or FMCG into, sorry, Nifty into this plus this into this plus IT weight into IT returns plus gold into gold returns. And I start 100 here. My equity is this. Actually, this is into 100 because it's number, right? So I'm calculating into percentage now.
Mm.
Yeah, so if I had selected IT and FMCG, I would have been down by 7% here, half, and I gained only 2% here. So I'm actually down by 5% in this month. So FMCG IT was not a good solution because I would have lost 5%. Now this is better. I lost only 2.5%. Now what did we achieve? So it's into 100 plus. Okay. We matched the same Nifty 50 returns, right? About 338 returns. If I open that sheet, where is that? Umesh. Four assets. This is not required. Actually, we already have this because that's what the other sheet. So I need to copy this. All right. This is four assets, alpha.
Alpha.
This is not there.
Yeah.
Here, my benchmark is there, and I'll just get my asset returns. This will go. Instead of that, this will come. Looks fine. Not much difference, but we are getting little higher returns, about 12.5% versus 12.33. That is translating to 10 rupees extra over a 10-year time frame, with a less drawdown, half the drawdown than what the single asset is experienced. Nifty 50 is experienced. Much higher Sharp, 43 versus 60. Lower beta, higher alpha, and not so great R2, but I would still take it.
I mean, because of the MDD. I mean, because of the drawdown.
No, because I'm comparing that with this. So if you look at R2 here, right?
Yeah.
This is 26 versus
okay.
79. Like now I'm comparing between various buckets.
Okay.
Yeah, but now at least I have a framework to compare. Do I go
Right.
or do I go for this? This one, right?
Right, correct, yeah.
And this is 273 and this is 332. Okay, let me go for this. I mean, at least your mind is working better than throwing dots.
Got it.
That is about it. And I would have given somebody chance to operate this by plugging in different values. This you can delete. I mean, like something else I would put. You also can plug in 6 portfolios. The same method. Delete everything and put the new data whatever the way you want. And same method and optimize. Maybe change these names like how I changed. And fiddle around with Sharpe ratio. And mix and match each asset class that you want to explore. Mix and match your weight allocation. I just put 10%. Maybe you want to put only 5%. The upper bound instead of 40, maybe you want to reduce it to 30. Maybe you want to increase it to 50. I don't know. Yeah, but like by various combinations, you decide this particular allocation, right? Now, one question is whether this would have worked or not. I don't know. Now, what I'm doing is I'm just going back to the Corona period, this one. This is where Corona started, and we don't know whether Corona would start or whatever, right? So I'm just taking this data. And I am going back to that period. So this would be
December 2019.
Correct. Rest is okay, don't bother. After 120, so I don't know how many data points I deleted. Let me make a copy and then fiddle, okay? All right. So this is what my data set would be now. And I'm deleting the entire stuff. And get this data as 31st December 2019. I am passing only 97 values. Instead of 10 years, I am passing now 90. What is that number? Just remember 97. So go here and this becomes 97. What would have been my optimization at COVID period, before COVID started?
Gaurav, one quick question on the solver.
Yeah.
If you click on solver again, right? You're optimizing for Q42, which is Nifty.
No,
Click
no.
on,
Oh.
yeah, that's the reason it's coming as high.
Okay. You should have told me.
Yeah, Q70. So, yeah.
Now I think, let's see. Okay, now the ratios are this 24, 40, 26, and 10. Let me just see here where I put solver.
42 only. Yeah.
You are right. So I have to put 70. What's the ratio? Same 10, 40, 40, 10. Actually, now your returns would have been much better. Yeah, see, they've gone all the way to 480. Sorry, 389 versus Nifty of 300. Yeah, this is much better now. So you are getting excess returns, better drawdown, and better R2. Now, pre-COVID. Where is pre-COVID? This is pre-COVID, right? So pre-COVID, you would have gone with this allocation, 24, 40, 26, and 10 gold. Now take this allocation and just take the pre-COVID period, like that 1 year. Which one?
First Jan. Yeah.
What you would have done in that particular year, right? I'll put December also. And what would have been my returns? I've gone ahead and invested like that because that's what my solver told me. and I came out better. I lost only 10%, or I've just experienced 13% drawdown in COVID, right? If somebody would have told you this, you would have felt much better, right?
Yeah.
Yes.
Against the
Definitely.
market of 38% drawdown.
And your drawdown here is only 13%, 87 minus 100.
Hmm.
And you recovered by July. Sorry, actually you recovered by June, your original investment. And you rallied. No way you could have generated 31% returns in COVID year. Panicked somewhere in between. And the point that I want to mention here is sorry, this is a pre-COVID allocation. Oh, we took it wrong. Still better, the same number instead of 31, 130, you got it 125 or 126. And the drawdown is the same, just 15% drawdown versus 30% for the market. And this is pre-COVID allocation. Today's allocation is this one. If we were to do this today. What you are changing is not significant portion. If you are looking for tax calculations or whatever. So your FMCG is the same, right?
Yeah.
And all that you changed is Nifty, you sold 14%, and you put that 14% into IT, right?
Yeah.
So you are just doing one transaction, selling this Nifty, putting in IT. And the rest remains same. So the point here is you don't, when you are resetting once in a year or once in 2 years, once in a year, this equation doesn't change much in terms of your rebalancing, right? Thus, you are reducing any tax consideration. Here, your tax consideration is, what is your tax consideration?
Based on the tax bracket you fall under.
Whatever it is. So now let's say it is a 10 lakhs allocation here. So how much I have put for Nifty?
2.4 lakhs.
And let's say I haven't returned anything, or I have returned 0%. What is my allocation here?
1 lakh.
1 lakh. What am I selling?
You're selling equity Nifty and buying into more into IT, which is
What
again,
am I selling? Selling is what tax you have to pay, right? 1.4 lakhs of Nifty I'm selling. Right?
Yes.
Assuming Nifty rallied by 100% in this time frame, how much gains I would have made?
2.4 lakhs.
1.4 lakhs is my gain.
1.4.
And this is what I need to pay long-term tax. How much is that?
10%.
It is not 10%. It is up to 1 lakh, you will get benefit. You have to read the rule. So you will only pay tax on 40%. Sorry, the 40 lakhs, 40,000 at a 10% tax rate, which is
4,000.
that's what it is. Even if you take 10% on 14 lakhs, 1.4 lakhs, it is 14K. I don't mind paying 14,000 tax on a 10 lakh portfolio. But if I utilize that rule of 1 lakh limit or 1.5 lakh limit, some exemption limit is there, I would just end up paying 4,000, which is much better, right?
Yeah.
And what is the brokerage? Zero.
Oh, yeah. Yeah,
Or
0.
maybe one transaction, like 10 rupees, 20 rupees, right?
Yeah, no brokerage. Yeah.
Maybe 20 rupees brokerage, and your tax is 4,000, and you are much off. Even in a COVID year, this is what you got, 25% returns.
Yeah.
Actually, from COVID to now, it's not, Nifty hasn't rallied anything. So it was at 12,000, now it is at 18,000. So it's only 50% returns. So your long-term tax is on 70,000, which means you are actually not paying any tax as of now. 1 lakh limit is there, right?
Yeah.
So you don't pay any tax if you have done this. Pre-COVID, if you have done this, and as of today, if you want to switch into this, your gains, realized gains is only Nifty. Everything is unrealized gains, so you don't pay any tax. Your realized gains on Nifty would be about 0.7 lakhs, 70,000. That anyway is IT exempted. So your tax rate is 0. And your brokerage charge is 1 transaction. And to do all this operation is about 1,000 rupees webinar charges. That's all, right? And you can fiddle whatever you want the way. If you don't like Nifty, you replace it with NASDAQ. If you don't like FMCG, replace with Momentum Index. If you don't like gold, you replace with something else. And see that you are satisfied across all the spectrum. This one and this one, right?
Yep.
And more importantly, the standard deviation. And obviously this too. Reduce the beta, and obviously will increase the alpha if you reduce the beta, and see this number to be lower than 50. My preference would be lower than 50 or somewhere around 50, right? Fiddle around and get your own asset allocation mix, and you stick to it. There's nothing to worry, because irrespective of whatever people say, this is what we have seen in the COVID. We can't see worse than this. Where is the COVID? We can't see anything worse than this. Maybe a little more worse, but that's fine. I'm okay. Even if it goes up to 80, right?
Yeah.
Or maybe 75, because anyway, if I had bought a Infi stock, which is already down 20%, so I should be living with 75% order. I mean, 25% order. You will do better. Whatever the allocation, you get a grip on it. So this is your mean variance stuff.
Okay.
As of now, what the mean variance I have suggested on 31st December 2021 is standing at this one will cost you about 9,000. So, and you can reclaim. If you have paid me anything in any seminars, you can reclaim against this 9,999. So my mean variance portfolio as of April, as of March end, April end I still haven't calculated, is down by just 2%. And I've gone with that allocation, 10% in quality ETF and 10% in value and 30% in NASDAQ and 26% in momentum and 10% in gold Wiz. And gold is up, everything is down. So my portfolio is down 2.5%. Nifty is rallied about 0.64%. I'm not that bad. I'm underperforming, but that's okay. You can also calculate one small thing here. This is what you have done. Your 100 becomes, right? Where is your 100 becomes? This one. What you can do is you can just do a filter, and you started at April, right? Every April, so just select April. This is what your Nifty returns. And this is what your portfolio returns, right? Now compare this, you started with 100. This is March. Actually, the starting point is a little different. That's fine. So Nifty has given this much returns, and your portfolio is this much returns. Make it 2 digits. Just see how many years you are outperforming and underperforming. So if your equity is greater than Nifty, out. Otherwise, under. Right?
Kurai, equity is combination of all those IT and FMCG and all.
I mean, the asset combination I have selected.
Which is the 4 asset classes. Is that one?
Yeah, whatever.
Oh.
So I know that I underperform in 3 years. Right?
Yeah.
And ultimately, I'm doing better than Nifty because 330 versus 390. And when I underperform, the worst underperformance is about this one. Right?
Yeah.
I'm prepared. Like even if I'm underperforming by 15%, that is what exactly happened in history. So I'm okay to experience that 15% of underperformance in future. Because I will outperform in some years. Actually, this is also a big underperformance, about 8%. This is a massive outperformance. A lot of money would have flown into you if you are managing this fund. And here as well. And in COVID year, you lost only 6%, whereas other guys have lost 16%. Nifty. a lot of money would have come to you if you are managing the fund. But again, after outperformance, you underperform. So people would be in dilemma whether to withdraw the money or not. Right? Yeah, you can ask. I have just 5 minutes. I need to leave. You can ask me any questions.
Hello.
Yeah.
Yeah, I wanted to ask you, you have chosen this mean variance. There are other portfolio optimization methods. Somebody combines the Kelly method or is doing a risk parity. So how do you go along?
This
with
is a
that?
risk parity only. This allocation is risk because you are reducing risk.
You are not using any hedging, like, you know,
Because it's not required. You already have gold as hedge in this portfolio.
okay. And suppose I'm doing a momentum thing. I'm taking 6 months, 3 months, 12 months risk adjusted momentum. And when I'm calculating the standard deviation on that, it's suppose I'm taking a 6 monthly return on stocks and calculating a standard deviation for the 6 month. And when I'm calculating a standard deviation for 6 into 30, 180 period, then these two are giving me different standard deviation value in the monthly and the daily format. So I'm a bit confused about that. I'm taking this
daily
data. I am taking this data from charting because it's
whatever the data source, go back to NSE because that's the best data source.
Yeah.
They will give variation daily versus monthly.
Yeah.
I won't be fine granular in daily. I would only doing monthly prices.
Okay.
I mean, my preference.
Yeah. And if one has to do rotation on monthly basis, then how should one go along?
It's a very costly exercise. Don't do it on monthly.
Okay.
Because you are paying tax. This whole thing which I erased. Where did I erase, right? Yeah. There I haven't paid any tax and I haven't paid any brokerage.
Yeah.
I'm doing that on monthly. So every time this particular equation would be changing because it's software and Excel. It will throw numbers. If it says 0.9 instead of 0.1, right?
Mm.
Instead of 10, if it says 9, which means actually we're paying brokerage.
Yeah.
And you also might be paying a tax because it's a very short-term trade now. It's not long-term trade anymore.
Yeah.
If you make money, you have to pay 15% tax.
Yeah.
So it is not worth.
And the last question, you have taken all these things from the index only, like, you know,
Yeah.
and suppose I'm doing some stocks, which is not an index, like not even in micro cap, then how should one proceed?
I'm not basically a stock picking fan. I would stick to ETFs.
Okay.
I would, if I have 100 rupees, probably 95 or 97 rupees, I will put into this ETFs or whatever. May not be in this method, in the same something like that. And the whole problem with this is it will never give you 100% returns in a month or in a year because these are all big indices.
Yeah.
And you won't get that gambling urge. Like now, if you see the NSE returns, where is that NSE? Market data, indices. Micro cap. I'm just taking that because that's a very good set of stocks which gyrate a lot. There should be a figure which is yearly returns. Okay, they haven't done this for this. Maybe let's check for this index. They haven't done here. Do they do only for Nifty or?
Cora, that is there in NS. So this is the new website.
No, I think if you download it, you might get it. Yeah, that end column is there. So it will be there on microcap. Let's check microcap. This particular basket of stocks have given 100% returns. Sorry, 200% returns. There's no way I could have picked them, but if I pick them, that gives me my gambling instinct. Like, oh, I picked up a multi-bagger. Whereas this gambling urge would never come. It will never be realized if you are picking ETFs, like Nifty ETF. It will hardly move 10% in a year or 20%.
Yeah.
Or IT ETF. It will again do the same stuff. But net, whatever your stock picking is, it will boils down to this. You always come by picking up winning stick. So you can't outperform your benchmark. So even if you go to micro cap, there's no way you could have beaten. Where is that? This figure in a long run. In 1 year, I beat, but over a long run, there's no way you could have beaten. Because we proved that, right? In the first 10 minutes.
Yeah. And one more question.
To satisfy your gambling urge. That's why you go and pick the stocks. So my would be, I'll put 98, 97 in ETFs. I'm comfortable, and maybe 2 rupees into throw any dots based on TV or based on my research or anything. Okay, now this stock look good. Maybe put 10 paisa into this. Like that, I pick up 10 stocks, 20 stocks. Then when I open my terminal, I will see some stock going up, down. That gives me satisfaction, like my gambling urge. So if you want to see my portfolio, this is not my portfolio. This is my portfolio. I cannot show you. This is my. This is my friend's wife's portfolio. I manage this for about 2 years. They started with about 10 lakhs. I think not 10, 12 lakhs. Right now it is standing at this much. Now, this has about 30% of it is in ETFs. You can check Nifty and things like that. ICICI Auto Index, then Nifty, Bank Bs. You will see Momentum, 100, NASDAQ, Auto Index, IT Index, NV20. This is Nifty 100 fund, Pharma fund. So I would say about 40% of this is in ETFs already. SBF ETF quality, SBI ETF quality. These are gold bonds. And this portfolio is running for more than 2 years. Now, the thing is, look at my Nifty holdings. Where is this? GHIJKLMN. Nifty Bs. Nifty Bs is only 30,000, but again, you have to see the mutual fund holdings. That is in other tab. This tab. Coin, right? So these are again all ETFs. I don't know what all I'm holding. Yeah, so this is again entirely ETFs, right? Now, whenever I sort, right, daily change, your Nifty will never come on top here.
Yeah.
Or when I do a net change here, this is from my investment. Your Nifty will never come here or at the down. It will be somewhere in bottom. So now I want to see, oh my God, I'm some 200% gaining stocks, right? There are like bunch of them. But I would have just put a very small allocation because I can't put more than some limit, which is 20,000 or 30,000.
And for the stocks you have chosen here or from the insider portfolio, do you have any like liquidity criteria for them? Minimum
No, for this
volume
kind of portfolios, I don't, because it's just a 20 lakhs. Even insider is that it will already translate to 2,000 rupees or 5,000 rupees. So it doesn't matter.
Oh,
I mean,
thanks.
5,000 doesn't matter even if there is no liquidity.
Yeah.
This is my manual of momentum portfolio. The 20 stocks which I publish, I do quarterly rebalancing and a bit of Nifty 10 portfolio, Nifty junior portfolio, and a little bit of insider trades and a little bit of micro caps. The micro cap is VRL Logistics. This is micro cap. I think this is micro cap. This is momentum stock. And even though this is fallen 40%, right, in the last 1 week.
Yeah.
I don't care. See, I mean, I'm not bothered. Like a lot of people are now panicking. Oh my God, why should I? This has gone to 80, I think. All the way from 80, it is falling to 40 now. I don't panic because, yeah, even if it goes to zero, I will only lose this much. And obviously, it doesn't go to zero. And my entire loss is only this much. So unlike other people who are panicking because of the 50% fall, yes, I would also panic. But because I'm diversified, that effect is only small. This is change, right?
Yeah.
On a base of 20 lakh portfolio. So I don't really care. So that is why I insist diversification.
Thanks a lot.
And whatever stock picking you do, actually I closed it. You hardly get 2-3 stocks like that, which are multi-baggers. Because you also pick up losers, right? It's not like you'll only pick up winners always.
Yeah.
All right. I have to stop recording.